55. I use these two moving averages in conjunction to represent the general direction of the market. I'm also looking at the angle and separation. If the angle is steep, the market's moving quickly. If it's narrowing, or in this case even diminishing, it's slowing down. Okay. I use 5/8 for price. If the 5 is below the 8, price is falling. I also look at angle and separation. Okay. Market, in this case, price action is moving quickly, then it braids out and consolidates. I use the 200 EMA to represent not just trend, but fair market value. Oh, Booyah says he wants to know more about booking profits. Oh, I can definitely help you there. Hey, Kenny, on YouTube. What's up? Okay, volatility. Another way of looking at volatility is you can almost say volume. It could be a substitute. And these are Bollinger Bands. Okay, and when they're narrow here, nobody's trading, and when they're wide, a lot of trading. So you can see in here what the Bollinger Bands are telling you is not many people are trading. The volume is really, really low. Okay, now it's really technically volatility, but sometimes I use it as a substitution. Oh, Booyah says you can't let it run forever. Yeah, but you should. Okay, so, Booyah, make sure you ask. I can definitely help you with that as far as when do you take profits and all that kind of stuff. There's a couple of different strategies for that. I'm happy to share. Okay. And then I use the MACD. I slow the MACD down to represent overbought and oversold conditions for the market. And then I speed stochastics up to represent overbought and oversold conditions for price. So just like the moving averages, I use oscillators to separate market forces from price action. And the idea here, the genius of it all, is I try to sell in a falling market and I try to buy in a rising market. I know, right? Genius. 200 EMA, which time frame? Great. Another YouTube question. Great question, YouTuber. Every time frame you're measuring. Okay? Every time frame you're measuring. So I often look at the 15-minute, the 1 hour, the 4 hour. They each have their own trend. And sometimes I need to be long-term long, but short-term short. That's fine. But you need to look at more than one time frame. So here's what one chart looks like, but I'll actually look at multiple charts. Okay. All right, so we got to cover this because we're about 13.5 minutes approximately, right? 1382 from the news. The news is going to come out and the market's going to move up or down. Okay? We don't know which, and I'm not going to guess. I'm not going to straddle the market either. I don't need a dog and pony show. I don't need smoke and mirrors and call it trading. So I will let the market react to the news and I'll make a decision. If the market reacts bullishly, I'll say, oh, I guess the market reacted bullishly. Right? If the market freaks out and it goes bearish, I'll say, oh, look, I guess they responded bearishly. Okay, it's fine. I don't need to be in on the first candle. So what we'll do is we'll probably wait 3 or 4 minutes and catch a pullback. So if it goes green, and these are 1 minute charts, 1 minute candles, by the way. If it goes green, I'll say, oh, look, I guess it's bullish. And then I will wait for a retracement, maybe in this roll reversal, but I'll use a Fibonacci as well, and I'll look to go long somewhere between the 3A2 and 618 Fibonacci retracement, somewhere where this arrow is pointing. And you can see, oh, I'm right on the 50%. So I'd have my, and this roll reversal. See the roll reversal here? Beauty. So I'd be ready, finger on the trigger, ready to go. I'm salivating. I want to pull the trigger, but, ooh, not quite yet. Okay, it did 786. Now, I could have, for example, gone long at that 50% with the roll reversal. Not a bad idea. I could have waited a little bit longer. Little extra confirmation. That's fine too. You need to make a decision. Either way, even if you went long on the 50%, which I get, I understand that logic, your stop should go below this lowest low. So at the end of the day, you're risking a big whopping 18, 19, 20 pips. If you lose more than 25 pips on a trade today, it's your own damn fault, and I don't care. Wayne, that's so mean. Yeah, it's called free market. You lose your money, it's your fault. Right? I'm trying to give you advice on how not to lose money, but if you lose money, you don't lose a lot of money. So if you lose a lot of money today, you're not listening, and therefore you're fair game, right? Because there are people that make money in the markets, and then everyone else is a liquidity event. So if that's what you choose, that's fine. We need people like that in a zero-sum game. So that's your choice. So if you pulled the trigger in here and you put your stop here, yeah, you're risking a whopping 25 pips. But this is a high volatility event-driven strategy. So if you lose, you're going to lose 25 pips, and probably won't take you long to lose 25 pips. But if it continues, you should be able to make money because of the volatility is working in your favor. So you get to this point where we get back to this line in the sand, and one of two things is going to happen. It's going to form a double top and drop and knock you out. So if you get, after about 5 or 6 minutes, your trade should already be profitable. And if you are, hopefully right before you get to the line in the sand, which is the previous high, move your stop closer, ideally all the way to break even. So you move it from this low to wherever your entry was. Okay, let's say this 50%. Now you have 8 pips profit and your stop's at break even. Yeah, but it's a high volatility event driven strategy. It's not a swing trade. It's not a spot trade. It's a scalp. It's unique to this situation only. So it'll either form a double top and drop and knock you out at break even, or it'll break through the top and you get paid. That's what you want to do. Risk a little bit, risk none. No joke, on this trade today, you'll either lose your 25 pips or less, right, fairly quickly. But if you get it right, you should be able to move your stop to break even within like 6 minutes. If 4 to 5 to 6 minutes go by and you're not profitable, it's probably not going to work out, guys, because it's not a scalp. We do see this from time to time in non-farm payrolls where we don't get the volatility, and we get a decent entry, and it just kind of moves sideways for 15, 20 minutes. That's not the trade you signed up for. It was a scalp, right? So if it doesn't launch, boom, like this, after 8, 9, 10 minutes, 15 minutes goes by and it's still moving sideways, you might as well just take your loss, take your profit, doesn't matter, just move on, because it's not your trade plan has just failed, I guess. Even if it's profitable, if it didn't take off, it's not the plan.